This is part 1 of the presentation for Module 6 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs. In Module 6, we will examine 3 balance sheet elements: inventories, long-term assets, and accounts payable, and consider various analysis methods as well as asset impairments and restructuring activities. In this learning objective, we will evaluate inventory costing methods. For most companies, inventory is among the 4 largest assets on the balance sheet, along with receivables, property, plant, and equipment, and intangible assets such as goodwill. On the income statement, cost of goods sold, which is directly related to inventory, is the largest expense for many companies and certainly for those in retailing and manufacturing. Companies can choose from among several methods to account for inventory cost, and these accounting choices can greatly impact the balance sheet and income statement accounts. Although rare, companies can and do change inventory costing methods if doing so enhances the quality of their financial reports and the company can justify the change. The graphic on this slide illustrates the flow of cost and distinguishes between costs that are capitalized and those that are not. Inventory expenditures follow the cost capitalized line at the top of the graphic. Cost of inventory is added to the balance sheet as an asset capitalized when it is purchased or manufactured. Inventory cost is transferred from the balance sheet to the income statement as cost of goods sold when the products are sold. Capitalization simply means that a cost is recorded on the balance sheet rather than being immediately expensed in the income statement. For purchased inventory, the amount capitalized is the purchase price. For manufactured inventory, we capitalize the cost of 3 components: cost of direct or raw materials used in the product, cost of direct labor to manufacture the product, and manufacturing overhead. Direct materials cost is relatively easy to compute. Design specifications list the components of each product and their purchase costs are readily determined. The direct labor cost per unit of inventory depends on how long each unit takes to construct and the wages and salaries paid for employees who work on that product. Overhead costs are also capitalized into inventory. These include all manufacturing costs other than direct materials and direct labor, such as utilities, supervisory personnel, repairs and depreciation on manufacturing property, plant, and equipment, as well as other related costs. Measuring and analyzing the flow of inventory costs are important. If all inventory purchased or manufactured during the period is sold, then cost of goods sold is equal to the cost of the goods purchased or manufactured. However, when inventory remains at the end of the period, which is the usual case, companies must distinguish between the cost of the inventories that are sold and reported as cost of goods sold in the income statement and those that remain as an asset on the balance sheet. The remaining inventory is available for sale in the next period. This slide shows the typical income statement of cost of goods sold and the calculation of gross profit. It is important to understand that companies have a choice when it comes to determining the cost of goods sold and the cost of inventory remaining on the balance sheet. 3 inventory costing methods, FIFO, LIFO, and average cost, are all acceptable for U.S. GAAP. The FIFO inventory costing method transfers costs from inventory in the order that they were initially recorded. That is, FIFO assumes that the first costs recorded in inventory are the first costs transferred from inventory. This slide illustrates the FIFO costing method. The company begins the period with 500 units of inventory that were purchased or manufactured for $50,000 or $100 each. During the period, the company purchased or manufactured an additional 200 units costing $30,000. The total cost of goods available for sale for this period is $80,000. The company sold 400 units during the period at $250 per unit for total sales of $112,500. Applying FIFO means that the cost of the 450 units sold comes from the beginning inventory, which consists of 500 units costing $100 each. Thus, cost of goods sold would be $45,000. Subtracting the $45,000 from the sales price of $112,500 yields gross profit of $67,500. The ending inventory would consist of the remaining 50 units from beginning inventory at $100 and the 200 new units at $150 each, for a total of $35,000. Another way to calculate ending inventory is to subtract the cost of goods sold, $45,000, from the goods available for sale of $80,000 to arrive at $35,000. The LIFO inventory costing method transfers the most recent inventory cost from the balance sheet to cost of goods sold. That is, the LIFO method assumes that the most recent inventory purchases are the first cost transferred from inventory. The company's cost of goods sold under LIFO would be equal to the newer 200 products at $150 each, or $30,000, plus 250 of the beginning inventory at $100 each, or $25,000, for a total cost of goods sold of $55,000. The resulting gross profit would be equal to the sales price of $112,500 minus the $55,000 cost of goods sold, or $57,500. The ending inventory would consist of 250 units at $100 from the beginning inventory, or $25,000. Alternatively, you could subtract the cost of goods sold of $55,000 from the $80,000 goods available for sale to arrive at the same $25,000 for ending inventory. The average cost method computes the cost of goods sold as an average of the cost to purchase or manufacture all the inventory that was available for sale during the period. To compute the average cost of $114.286 per unit, the company divides the total cost of goods available for sale, $80,000, by the number of units available for sale, 700. The company's sales, $112,500, cost of goods sold, $51,429, and gross profit, $61,071, are calculated as shown. The cost of goods sold and ending inventory are determined by multiplying the number of units sold, 450, and the number of units remaining, 250, by the unit price of $114.286 to arrive at $51,429 for cost of goods sold and $28,571 for ending inventory. There is usually some rounding differences when computing cost of goods sold and ending inventory using average cost. The average cost method is commonly adopted when inventory purchases and sales are continuous during the year. This method is especially common for retail companies that stock and constantly restock non-seasonal items, and for manufacturing companies that use commodities as raw materials. Retailers such as Home Depot and Lowe's commonly estimate the cost of ending inventories using the retail inventory method. Retailers know the cost of the inventory purchases as well as their retail selling price. From this, the retailers compute the cost to retail percentage and apply the percentage to estimate the cost of the inventory still available at year end. This slide illustrates the retail sales method. The retail sales, $420,000, are deducted from the cost of goods available for sale at retail, $660,000, to estimate the ending inventory at retail selling price of $240,000. This amount is then multiplied by the cost to retail percentage of 60.6% to yield estimated inventory at cost of $145,440. This amount is deducted from cost of goods available for sale, $400,000, to yield cost of goods sold of $254,560. The cost to retail percentage is determined by dividing the cost of goods available for sale, $400,000, by the cost of goods available for sale at retail of $660,000. Since this ratio is very important, managers review it regularly for reliability. The three inventory costing methods yield differing levels of gross profit as shown on the slide. Recall that inventory costs rose during the period from $100 per unit to $150 per unit. The higher gross profit reported under FIFO arises because FIFO matches older, lower cost inventory against current selling prices. To generalize, in an inflationary environment, FIFO yields higher gross profit than LIFO, or average cost. In recent years, the gross profit impact from using the FIFO method has been minimal for companies due to the lower rates of inflation and increased management focus on reducing inventory quantities through improved manufacturing processes and better inventory controls. The FIFO gross profit effect can still arise, however, with companies subject to high inflation and slow inventory turnover. In periods of rising costs, LIFO inventories are markedly lower than FIFO. As a result, balance sheets using LIFO do not accurately represent the costs that a company would incur to replace its current investment in inventories. A second issue is that financial statement users cannot compare LIFO and FIFO inventory numbers across firms, as the balance sheet and income statement numbers are not equivalent. Thus, U.S. GAAP requires that firms choosing LIFO also report in their footnotes the equivalent FIFO inventory amounts. The difference between FIFO and LIFO inventories is called the LIFO reserve. Caterpillar's footnote regarding their inventory cost if FIFO was used instead of LIFO indicates that the 2018 balance sheet omits over $2 billion in inventory costs by reporting inventory at LIFO. When inventory costs rise, the LIFO method yields lower net income. Assuming that companies and investors prefer high net income, one wonders why any company would use LIFO. The answer is taxes. Unlike most other accounting method choices, inventory costing methods affect taxable income. The IRS is the only taxing authority in the world to allow LIFO. LIFO is not permitted under IFRS. Using LIFO increases cost of goods sold, which reduces taxable income and taxes paid. The net result is real cash savings. Companies weigh the cash flow effect against the financial reporting effect when selecting among LIFO, FIFO, and average costs. A LIFO conformity rule in the U.S. tax code stipulates that if a company uses LIFO for its tax filing, it must also adopt LIFO for financial reporting. This rule limits companies' ability to cherry pick among accounting methods. The LIFO reserve quantifies the difference that LIFO creates. Caterpillar's use of LIFO has created significant tax savings over the years. Through 2017, Caterpillar's cumulative taxable income was reduced by $1.934 million. With the 35% tax rate in effect during that period, the company saved $677 million in taxes, which increased after-tax cash flow by the same amount. In 2018, the LIFO reserve increased by another $75 million with an additional tax savings of $16 million. In this learning objective, we will examine inventory disclosures in the financial statements. Footnotes to financial statements describe the inventory method a company uses. Like many retailers, Home Depot uses FIFO to cost its inventory, along with the retail inventory method described earlier. Then, at the end of each accounting period, Home Depot compares the ending FIFO inventory balance with the market value of the inventory or its replacement cost. If the market value is less than the FIFO amount, Home Depot writes down the inventory to its market value. The result is that the inventory is carried on the balance sheet at the lower of its cost or market value. The inventory write-down is a non-cash expense that is reflected in cost of goods sold, which reduces the gross profit reported on the income statement. Caterpillar uses LIFO for most of its inventories, but neither the IRS nor GAAP require the use of a single inventory costing method. That is, companies are allowed to, and frequently do, use different inventory costing methods for different types of inventory. We can use the LIFO reserve to adjust LIFO inventories on the balance sheet to their FIFO value using the equation shown. In general, we use three adjustments to convert LIFO to FIFO on the balance sheet. First, we increase the inventory by the LIFO reserve. Next, we increase tax liabilities by the tax rate applied to the LIFO reserve and increase retained earnings by the difference. For example, to adjust Caterpillar's 2018 balance sheet from LIFO to FIFO, we would increase inventory by $2.009 million, increase tax liabilities by $693 million, and increase retained earnings by the difference of $1.316 million. Because companies can choose among the various costing methods, their financial statements are often not comparable. The problem is most serious when companies hold large amounts of inventory and when prices markedly rise or fall. If we compare Caterpillar to Kubota, a close competitor that uses FIFO to cost its inventory, we would conclude that Caterpillar holds slightly more inventory than Kubota. However, this is not an apples-to-apples comparison, and as such a conclusion is erroneous. Fortunately, companies that use LIFO must report their LIFO reserve, and we can use these disclosures to adjust the LIFO numbers to their FIFO equivalents. Once we convert Caterpillar's inventories and its total assets to FIFO by adding the LIFO reserve, we find that the company holds 17% of total assets in inventory, a greater difference than first noted. To compare the income statements of companies that use LIFO, we just adjust cost of goods sold from LIFO to FIFO. Recall that cost of goods sold is equal to the beginning inventory plus purchases minus ending inventory. To determine FIFO cost of goods sold, we must add the change in the LIFO reserve to the LIFO cost of goods sold. During 2018, the change in Caterpillar's LIFO reserve was $75 million. Had Caterpillar always used FIFO, its cost of goods sold would have been $75 million lower, and gross profit and pre-tax income would have been $75 million higher. The company would have paid an additional $16 million in taxes using the 21% rate in effect in 2018. In 2018, the after-tax difference of $28 million in net income was not much because the LIFO reserve increased only slightly during the year, but in other years and for other companies, the impact can be great. When LIFO companies acquire inventory at different costs, they are required to account for each cost level as a separate inventory pool or layer. When companies reduce inventory levels, older inventory costs flow to the income statement. These older LIFO costs are often markedly lower than current inventory costs, assuming an inflationary environment. The net effect is that the LIFO cost of sales is lower than the equivalent FIFO cost of sales. The liquidation boosts gross profit as older, lower costs are matched against current selling prices on the income statement. The increase in gross profit resulting from a reduction of inventory quantities in the presence of rising cost is called LIFO liquidation. The effect of LIFO liquidation is discussed in the footnote for Rite Aid's 10-K for the fiscal year ended March 2, 2019. Snap-on Tools only uses LIFO for its U.S. inventory because IFRS does not allow it. To perform an analysis of the company, we must first adjust certain balance sheet and income statement items using the LIFO reserve. By accessing each year's prior 10-K, we can obtain the LIFO reserve for as many additional years as we believe are useful for our analysis. We will analyze Snap-on for 2 years using the LIFO reserve data as shown on this slide. To convert LIFO numbers to FIFO, we need to first determine the FIFO inventory by adding the LIFO reserve to the LIFO inventory balances. Next, we need to adjust the deferred tax liabilities by increasing them by the LIFO reserves times 25%, the assumed tax rate in effect for these years. Then we would increase retained earnings or equity by the difference. We would also need to adjust the income statements by decreasing cost of goods sold for each year by the change in the LIFO reserves. For 2017, this would be $1.9 million, 75.1 minus 73.2. And for 2018, this would be $3.3 million, 78.4 minus 75.1. The decrease in cost of goods sold would increase gross profit and pre-tax income. The income tax expense would increase by the LIFO reserve change times the 25% tax rate, and net income would increase by the difference in pre-tax income and the tax expense change. We could also calculate the change in net income by multiplying the change in the LIFO reserve times 1 minus the tax rate. LIFO to FIFO adjustments are crucial when we compare companies and when comparing a company to an industry benchmark. Further, the adjustments are necessary if we compare the company to itself over time. This is because the LIFO reserve that is built up in early years might be liquidated and then built up again and so forth, thereby changing the relative size of the reserve. The balance sheet effects for Snap-on were much larger than the income statement effects, which is typical for most companies. Also, the reformulation was large for inventory but less so for other key measures during the period. In this learning objective, we will analyze inventories and the related accounts payable. The gross profit margin is gross profit divided by sales. This important ratio is closely monitored by management, analysts, and other external financial statement users. The gross profit margin is commonly used instead of the dollar amount of gross profit, as the gross profit margin allows for comparisons across companies and over time. A decrease in gross profit margin is usually cause for concern since it indicates that the company has less ability to pass on increased product costs to customers, or that the company is not effectively managing product costs. Home Depot's gross profit margin on product sales increased by 0.3 percentage points for 2018. Home Depot attributed the slight increase to product mix changes, partially offset by higher transportation and fuel costs in the supply chain and shrink. The additional week in fiscal 2018 also contributed to higher gross profit. It is important to distinguish between factors that a company such as Home Depot can control and those that it cannot. This slide lists a number of factors that can adversely affect gross profit margins. Competitive pressures mean that companies rarely have the opportunity to completely control gross profit with price increases. Improvements in gross profit on existing product lines typically arise from better management of supply chains, production processes, or distribution networks. Companies that succeed do so because of better performance on basic business processes. A useful way to analyze inventory is to compare the income statement activity related to inventory, cost of goods sold, to inventory levels on the balance sheet. This helps us assess inventory management and provides insight into the company's efficiency in generating sales. Inventory turnover measures the number of times during the period that the company sells its inventory. Average days inventory outstanding, also called days inventory outstanding, measures the days required to sell the average inventory available for sale. Recall that Home Depot's fiscal year that ended February 3, 2019 included a 53rd week. We want to compare inventory turnover and days sales inventory across years for Home Depot as well as to competitors. To do this, we must first adjust for the 53rd week before calculating ratios. To do this, we multiply the inventory in the balance sheet by 52, divide by 53 to obtain the adjusted amount. Overall analysis of days inventory outstanding is important for at least two reasons. First, the ratio can be used to determine inventory quality. Fewer days is viewed favorably because it implies that the products are sellable, preferably without undue discounting. Conversely, more days implies that inventory is on the shelves for a longer period of time, perhaps from excessive purchases or production, missed fashion trends, or technological advances, or increased competition. Some explanations for higher or lower days inventory outstanding can include that the company has changed its product mix to higher margin inventories that sell more slowly. A company can change its promotion policies. Increased effective advertising is likely to decrease days inventory outstanding. A company can realize improvements in manufacturing efficiency and lower investments in direct materials and work in process inventories. Such improvements reduce inventory and consequently decrease days inventory outstanding. Days inventory outstanding can also be used to determine asset utilization. Companies should optimize inventory investment. Carrying too much inventory is expensive, and too little inventory risks stockouts and low sales. Companies can make operational changes to improve manufacturing processes by eliminating bottlenecks and subsequent buildup of work in process inventories. Just-in-time deliveries from suppliers provide new materials to the production line when needed, reducing the level of raw materials and associated holding costs. Demand pull production, in which raw materials are released into the production process when final goods are demanded by customers instead of producing for estimated demand, can reduce inventory levels. Harley-Davidson, for example, does not manufacture a motorcycle until it receives the customer's order. Most companies purchase inventories on credit, meaning that suppliers allow companies to pay later. The supplier sets credit terms that specify when the invoice must be paid. Sometimes the supplier will offer a discount if the company pays more quickly. Business-to-business payables are usually non-interest bearing. This means accounts payable represents a low-cost financing source, and companies should defer payment as long as allowed by the vendor. Consistent with the ratios we use to analyze inventory, we can calculate accounts payable turnover and days payable outstanding ratios. Accounts payable turnover measures the number of payment cycles in the year, and days payable outstanding measures the average length of time a company takes to pay its suppliers. Before calculating the ratio for Home Depot, we would first adjust cost of goods sold for the 53rd week. Home Depot pays its suppliers on average within 39.3 days, which is slightly longer than the typical supplier payment terms of 30 days. Delaying payment to suppliers allows the purchasing company to increase its available cash. However, excessive delays can damage supplier relationships. In managing the day's accounts payable outstanding, companies must take care to minimize available cash while minimizing supply chain disruption. The cash conversion cycle is equal to the days sales outstanding plus days inventory outstanding minus the days payable outstanding. Each time a company completes one cash conversion cycle, it has purchased and sold inventory and paid accounts payable and collected accounts receivable. The cycle increases cash flow unless the sales are unprofitable. The aim is to minimize the time to complete a cycle. Home Depot's cash conversion cycle has decreased over the 3-year period from 40.3 to 37.2 days. The biggest improvement was for inventory days, which dropped by 3.7 days over the 3-year period. Inventory management has been a strategic focus for Home Depot. Supply chain optimization is often cited as a key for effective inventory management. Inventories are recognized on the balance sheet when received in the distribution center, and the day's inventory outstanding clock starts ticking at that moment. Home Depot's challenge then is to minimize the time it takes to get the right amount of product from the distribution center to the store shelves. This involves accurate estimates of customer demand for products and an efficient logistics network. As inventories decrease, cash increases, and that increase can be large. For example, from 2017 to 2018, Home Depot reduced its days sales outstanding from 73.5 to 69.4 days, which increased the company's cash balance by $747.5 million. Computed as a change in days inventory outstanding of 4.1 days times the cost of goods sold of $66,548 million divided by 365 days. And this is the end of Part 1 of the presentation for Module 6 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs.